Hello, everyone, and welcome to today's webinar, FSRA's Deposit Insurance Reserve Fund Target Size webinar. And before we get started, I'd like to go over a few items so that you know how to participate in this event. You have the opportunity to submit your questions to today's presenters by typing them into the questions section of the GoToWebinar control panel. You can send your questions in at any time during the presentation. We will collect them and address them during the Q&A portion at the end of today's presentations. And with that, I would now like to introduce David Maxwell.
Thank you, and thanks everyone for taking the time for us this morning. I guess not terribly surprising that this is a topic of interest to the sector, but it's still gratifying to see so many of you join us this morning to interact with us on this subject. We have an hour today, and if we go to the next slide, you'll see the agenda. Our plan is to not talk for too long and open it up for questions, because the goal really here is to solicit your feedback. And given that hopefully each of you has had the material that we'll be speaking to you about today for a number of days now, we're not going to dwell on it too long and focus on the interactive portion of the day. My name's David Maxwell. I'll be your cruise director for today. Move to the next page. You'll see that I'm joined by my colleagues, Brad Hodgins, who's our Director of Risk Governance and Financial Stability, as well as Victoria Lasseau, who's Director of Policy for Credit Unions, Insurance Prudential, and Pensions. I think we're very much looking forward to the conversation, all three of us, and all three of us will be answering your questions at the end. Before we get started, however, I'd like to move to the next slide because it's important to acknowledge that the land we are on is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis peoples. We acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit and the Williams Treaties signed with multiple Mississaugas and Chippewa bands. And with that, I will turn it over to Victoria Lasseau, who's going to walk us through the early portions of this presentation.
Great, thanks, David. So the preliminary focus for our webinar today is to seek your views and answer questions on FSRA's proposed target deposit insurance reserve fund size that I will affectionately call the DIRF going forward. So this work is really guided by our statutory objects. It's also aligned with our annual business plan commitment to enhance financial stability structures that safeguard the credit union sector. And just as a quick recap, I'll just note some of the most relevant statutory objects for the credit union sector as cited in the FSRA Act, which guide our work on the DIRF every day. So those objects are contributing to public confidence in the sector, providing insurance against the loss of a part of or all deposits with credit unions, promoting and otherwise contributing to the stability of the credit union sector with due regard to the need for credit unions to compete effectively and take reasonable risks, and pursuing all of these objects for the benefit of the individuals holding the deposits with credit unions and in such a manner that minimizes the exposure of the DIRF to loss. So in recent years, the credit union sector has grown significantly, both in terms of assets and insured deposits. Some credit unions have entered into more complex and riskier business lines, and both of this underscores the need for a robust DIRF. The DIRF has also grown during this time as well, in commensurate with the growth of assets and deposits. But due to the changes in deposit insurance limits over the past years to historical losses, there's a continued need to continually assess the strength of the fund. So in this context, we do conduct a DIRF adequacy assessment on an annual basis. We are working to enhance our methodology. We also are required to submit a report to the Minister of Finance on DIRF adequacy on an annual basis. And as part of last year's report, our 2023 assessment, we committed to the Minister to consult with the sector on an appropriate DIRF size and optimal ways to achieve the revised target. And because of this requirement, we do have some Ministry of Finance colleagues here on the line to listen in and take notes for some of the questions and the views expressed. So with that, I will pass it over to my colleague, Brad, to get into the details of our analysis and our proposal for the DERF target.
Great, thanks, Victoria. So I'd like to start off by providing everyone a bit of background about how we got to where we are today. And so FSRA has been meeting regularly with the Deposit Insurance Reserve Fund Technical Advisory Committee, or as we like to call it, the DERF-TAC. Since 2021, we're providing information about the DERF adequacy assessment work. We've outlined the enhancements and additions made to the analysis framework and provided results of the assessment work on the adequacy of the DERF on an annual basis. This presentation and the supporting information that's included in the appendix provide a summary of the most recent set of assessments that have been completed on the DERF. As mentioned by Victoria, the CUCPA mandates FSRA to maintain the DERF as a key component of the Depositor Protection Program, safeguarding insured deposits and contributing to sector stability. The DERF is financed through the deposit insurance premiums collected from all Ontario credit unions and Caisse Populaire. The amount of premiums to be paid are determined using the differential premium score determination paper, as well as the calculation outlined in the Ontario Regulation 105. The differential premium score determination was recently updated in 2023 to include the risk ratings determined as part of the risk-based supervisory framework assessments as part of the calculation of the differential premium score, which is then included in the calculation outlined in the regulation. As of June 30th, 2024, the DERF was approximately $518 million, and this represented just over 97 basis points of insured deposits, which is slightly below the current 100 basis point DERF target. Due to a recent change in accounting treatment, DERF premiums are now realized at the point of the premium invoicing and not accrued throughout the year. As a result, the DERF grew by a substantial amount on April the 1st, when the premiums from the credit unions with December 31st fiscal year ends were invoiced, and this accounts for approximately 85% of the total sector premiums. While the size of the DERF in dollars will continue to grow throughout the rest of the fiscal year, due to the remaining premiums collected, as well as investment income on those DERF amounts, depending on the pace of growth of insured deposits throughout the rest of the year, the DERF coverage ratio may remain relatively flat or perhaps even dip a little between now and April 2025, when the next large cohort of premiums is added to the DERF. As a point of comparison, as outlined in the appendix, the Ontario's DERF target is currently the smallest, as well as the level of actual coverage of insured deposits is also the lowest of all of our peers across the country. Next slide, please. For the last 4 years, DERF adequacy assessments have shown that the current target of 100 basis points is insufficient to meet the expected funding required under various stress conditions. But no change has been made to the target, as the assessments were based to some degree on industry proxies and expert judgment. As the quantity and quality of the data received from the Ontario CU sector has improved over the last few years, the use of industry proxies and expert judgment has been reduced, thus providing results that are more indicative of the experience of Ontario credit unions. Therefore, the decision was made that the time was right to contemplate an increase in the DERF target. Appendix B provides an overview of the processes and inputs used to complete the most recent set of assessments on the adequacy of the DERF. We are working closely with the Ministry of Finance on the approach to determine the appropriate target size for the DERF to provide the necessary funding needed under various stress conditions. This collaboration aims to enhance our ability to fulfill our statutory objects effectively while taking into consideration the sector's outlook and the pressures faced by the sector. Our target setting approach is evidence-based and guided by our statutory objects and the results of the DERF adequacy testing. After the determination of the revised DERF target, following this consultation with stakeholders, FSRA will assist the ministry in evaluating any potential changes to the deposit insurance premium rates and the implication of these changes on sector's profitability, viability, and stability to ensure a balanced and sustainable outcome. Next slide, please. This slide outlines the three options that were contemplated as far as the DIRF target. So the first was a status quo, maintaining the DIRF at 100 basis points. This was originally set back in 2014, has been confirmed annually until 2022, and is expected to reach this target in 2025. In 2023, the target was maintained at 100 basis points, but we recognized that it was insufficient to meet deposit insurance obligations under various stress scenarios. So in the 2023 report to the minister, FSRA noted that while additional modeling and analysis was required, consultation with the sector would also be required prior to recommending a change to the target. Now, the second option was a move to 120 basis points as the target. 121 basis points was the amount of coverage required under the immediate shortfall analysis for the mild global downturn scenario. This scenario envisioned an economic slowdown in China and Europe with a negative impact on the Canadian economy. While FSRA recognizes that macro fundamentals have improved slightly, we are still cognizant of the fact that credit unions face increased mortgage renewal refinancing risk given high interest rates coupled with high household indebtedness. This is the recommended level for the DIRF target, as it would sufficiently address this adverse condition that has a moderate to high probability of occurrence. The third option was a DIRF size of 153 basis points, and this was determined through the analysis of the liquidity crunch scenario. This scenario envisioned a housing crash coupled with rising interest rates and high unemployment severely impacting credit unions' ability to maintain sufficient liquidity. This option contemplates a less plausible and more extreme economic scenario than option 2, with a low probability of occurrence, and therefore the rationale was to go with option number 2 as the proposed way forward. Next slide, please. Once the determination of the DIRF target is completed, the next important step will be the determination of an appropriate time frame in which to reach this target. The chosen time frame might necessitate changes to the deposit insurance premium rates. These changes need to be carefully balanced with the sector's ability to remain profitable and ensure the long-term stability and sustainability of the sector. FSRA welcomes your feedback on the determination of a reasonable timeline to reach the DIRF target, as well as potential future increases in deposit insurance premium rates to reach this target. Any potential changes to the deposit insurance premium rates would require a change to the regulations. These changes are under the jurisdiction of the ministry, and FSRA would work closely with the ministry to support them as they work through the process to implement any changes. Next slide, please. We kindly request that all written feedback be submitted to FSRA by Friday, August 30th, 2024, and please send your feedback to myself and Victoria at the emails provided on this slide. FSRA will consider feedback in determining the appropriate DIRF target as part of its annual DIRF adequacy assessment report, which will be filed with the minister later this fall. Following the determination of a revised target, we will work with the ministry in evaluating potential regulatory changes to enable necessary adjustments, if any, in the deposit insurance premium rates. Next slide, please. We will now proceed to the question and answer part of the webinar. Thank you for those who have already entered your questions, and we invite participants to enter your questions now into the questions portal on the right-hand side of your screen. I will now hand things over to David, who will lead us through the Q&A session. Thank you for your attention.
Thanks, Brad. And actually, it appears as if you explained things so clearly that we have no questions yet. A little bit surprising given the subject matter. And I think, as Brad articulated, We are absolutely soliciting written feedback and welcome that from the sector. I think to the extent that you could consolidate the feedback from your credit union into a single piece of feedback, that would be most appreciated just from a document management perspective. I think one of the key things here that we are soliciting feedback on is reasonable times in order to reach a new target, in addition to your thoughts on the target itself. And so to the extent that you have specific thoughts on that, feel free to enter that into the questions as well. And I see that questions are coming in now, which is great, and we will start to address them. I see that there are a couple of questions about whether this package was sent out prior to the meeting. Yes, it was about a week ago to the individuals who received the original e-blast. So our hope was that that would be distributed to those attending today's seminar. If that's not the case, I think we can absolutely do a scan of the attendees and resend the material so that you have a chance to review what we've spoken to in more detail, as well as see the appendices before you provide your written feedback. There's a question here, and maybe Brad, I'll send this one to you first, and then I can provide my thoughts. And it's, is there a willingness to review the investment risk policy position so that the market could potentially add some value versus just premiums to increase the DERF?
Yes, so we have begun discussions internally to determine if an investment advisor would be the right way to go. At the same time, so we're increasing the riskiness of the investments, but we have to maintain the liquidity of the DERF in order to be able to access those funds in a meaningful time frame, or immediately, as the case may be, in certain situations if liquidity is the issue, as opposed to a might slightly longer time if it's repaying depositors, but it's still only a few weeks versus an immediate draw against the DERF. So yes, we are actively looking at that as to what the best case for it is to sort of increase the returns without putting undue pressure on the amounts, and making sure that we can conserve the capital and not putting that at risk too high, because getting a large return but putting the principal at risk would defeat the purpose if there was a downturn or those investments did not pan out.
Great, thank you, Brad. Next question. Has there been a third-party review of the methodologies used in assessing the adequacy of the DERF? Brad, I'll let you start with that one as well.
Yes, over the last 4 years, we have had an external consultant, and we've used their economics department as well as their stress testing team to look at this, as well as we've to ensure that truly reflects the Ontario situation. As I alluded to earlier, as the data has become more available from the Ontario sector, we've had to be less dependent on expert judgment, i.e. using external providers to help us with that, as well as the industry proxies. And so, as we said earlier, not only has it been vetted externally, but it has also had the input of external parties who have done this work for other jurisdictions.
Good. So another question here that I think I've seen a number of iterations of, and just to sort of address this at the outset, the one I'm looking at now says if we assume a 5-year time period to increase the DERF to 120 basis points, what percentage annual increase in cost would be incurred by credit unions? That is something that is very much part of, first of all, our consultation process, and then our work to support the ministry in this regard. And so while we have, we're in the early stages of those discussions with the ministry, I don't think we're in a position right now to assess specifically what the cost will be to the sector. Victoria, Brad, I don't know if you have anything to add on that front.
No, at this point, it was too early. I mean, the idea was to ensure that we're all on the same page as far as the size of the DERF, then agree on, or sorry, the target, I should say, and then next work on determining what an appropriate timeline would be. Because if you've said that the target is X, you need to get there in a reasonable amount of time, because that's the amount of money that has been determined as being required to properly provide a backstop to the potential needs under these stress conditions. And then the final part would be, okay, how do we get there? So how fast would the DERF grow, taking into account the last 15 years of experience, as well as the changes to the new, the DPSD, which I think there's a question to that I saw on the list here, which I'm able to just answer it now, is that from our early experience from the reviews and looking at the scores that are coming out of the RBSF process, as we expected and as we had planned for, the overall premiums are not going to go up by a substantial amount. We're talking, 1 or 2% at most. But while you break that down to individual credit unions, there may be some credit unions that historically, under the old methodology, were paying a lower amount, will now be paying a higher amount. And so individual credit unions may experience either an increase or decrease depending on how the new methodology sort of pans out for each individual institution. But that being said, it will be more indicative of the risks of the credit unions and the potential and probability that a credit union would require funding from the DERF. So a fairness aspect has been introduced by including a more fulsome scoring into the determination of these premiums.
Great, thank you, Brad. Question for Victoria now. You mentioned the calculation is based on Section 110 of OREG 105/22. Congratulations to whoever submitted this question for remembering all that. Can you elaborate a bit on this? Thanks.
Sure. So the premium calculation is set out in the regulation under the Credit Union Case Populaires Act. It's under the purview of the Minister of Finance. So any changes would have to be approved by the Minister of Finance. And the calculation, the premium rate that is charged is per $1,000 of insured deposit, and the premium rate is 75 cents at the low end to $2.25 $2.25 on the high end. And there's a calculation to determine what the premium would be for a particular credit union based on their differential premium score, which Brad mentioned is the DPSD document, and that's something that FSRA publishes. And the regulation also says that this differential premium score has to be determined, that there's two components of that differential premium score: corporate governance and capital. So that's kind of a framework around what that differential premium score can be calculated on. And then FSRA's differential premium score document sets out a really detailed way for how to get to that score. And so the calculation is a combination of kind of a set rate for the premium per $1,000 of insured deposits and the credit union's differential premium score. And the regulation also requires FSRA to do the calculation within a certain time period of a credit union's fiscal year end. So I hope that answered the question. There's a few other parts in the regulation that in terms of the DERF, but that's the key aspects on the calculation.
Great, thank you, Victoria. And I think we have, sort of related questions here, which is how does the CU DERF in Ontario compare to what banks set aside? And what is the rationale for it to be higher or lower than the banks? And a second question that asks whether there's a provincial government guarantee or backstop to the DERF. Brad, maybe
Sure.
you can sort of touch on those two and why they're related.
Sure. Absolutely. So let's start with the comparison to banks. So at the bank level, currently the coverage is approximately 75 basis points of coverage. That is what that's the amount that the that the fund currently would cover. But in addition to that, there is an approximately, I think it's $28 to $30 billion backstop that the federal government provides to CDIC in the event that those funds would not be available, or the funds that are currently there would be used up. And if you put those two numbers together, that takes you up to the high 350 basis point, almost a 400 coverage at this point, versus what you're seeing provincially. So right now we do have a backstop that's in place currently that we can use. And that would take us up into the around 350 basis point coverage. But that is just it's a temporary, it's currently there. So as far as a backstop or a provincial guarantee, at the current time there is not one, but through the OFA we would have access to additional funds to support the amounts if it was over and above the amount that's in the DERF. But the expectation with the use of the line of credit is for short term, and that would have to be paid back in a short time frame. That is the caveats behind that. It's not a use it forever, because there will be fees associated with that, and repayments would have to be done in a timely manner, as per the other lines of credit that other Crown agencies have as well through the OFA.
Great. A couple of questions here, I think probably related to what Victoria had said earlier about the reg and the new premium calculation methodology. But questions about how the new methodology and the input from FSRA's risk-based assessments has impacted premiums at this stage. Brad, I don't know if you can provide some insights there. Obviously, we're still in a transition period where credit unions are paying the lower of the two values.
Right. So based on, and so everybody that has come to their fiscal year end, or their fiscal year end was at least 3 months ago, will have seen the new DPSD document and filled out with the two comparisons. So every credit union will now see, okay, what was my premium under the old methodology, what was my premium under the new methodology, and the lower of the two was charged this fiscal year. And so all credit unions will be able to see that, which was the lower amount. So there were a few credit unions where the amount under the new system was lower, and there were a few that were higher at this point. I don't have the exact, but the sort of the breakdown at the end of the day, as I said earlier, is that the expectation is that the overall premiums coming in are roughly at the same level. What I mean by that is that the average premium, which is around 80 basis points or 80 cents per thousand, not 80 basis points, so it's 80 cents per $1,000 of insured deposits. The average is expected to stay the same based on what we've seen thus far this year. Now, insured deposits have gone up, so therefore we are collecting additional funding, but it's not because of the premium rate, it's because of the increase in insured deposits. That's what's making up the difference. So you have to do an apples to apples comparison. So based on the same level of insured deposits, the premium rate is staying roughly the same. And so all credit unions now understand, based on their ratings, where their premiums would be on a rate basis, and then you just multiply that by your level of insured deposits. Now we are entering a continuous assessment or a continuous supervisory framework, where we're not on a regimented exam schedule as per the old days. And so it will be allowed to be more nimble, or able to be more nimble, responding to actions taken by credit unions in response to action plans that have been put in place in response to the recommendations and requirements that were outlined in the supervisory letters that credit unions have received. And we are on plan to complete those assessments this fiscal year, and therefore the transition period will not extend much longer. Because as we said in the original, the transition period will end once all credit unions have been assessed and have received their premium calculations first time.
Great. Thank you, Brad. We have a question about the comparisons between fund sizes and targets in various jurisdictions, and specifically about how different sort of coverage methodologies factor into our comparison to other jurisdictions. I think sort of referring to the I guess the level of deposits covered for each individual account. Brad, this might be another one from you. I can say yes, they have been factored in, but
Absolutely.
So confuse people by trying to explain it myself.
Sorry, I didn't mean to cut you off. So there are different levels of coverage in different provinces, but when you bring it back to the coverage, the basis point, everything is the same, because what you're saying is whether it's a coverage of 250,000 or unlimited, it's whatever that pool of funding is. So if, say, for example, I'm in BC, if they, I can't remember off the top of my head what the number is, but it's in the 130 to 140 range. I should have memorized these, I apologize. But the number is somewhere in that neighborhood. What that means is that although they have unlimited deposits, every single deposit's in there, they are actually covering 1.4% or 140 basis points of that pool. And so by moving it down to basis points, you're able to compare every province at the same level, because regardless of what the coverage level is, here are the total amount of insured deposits, and here's the size of their DIRF, divide the two numbers, and what was the coverage level. And so they are comparable. So when you bring it back to basis points or coverage ratios, it's an apples to apples comparison. And that's what we've shown in the appendix.
Great.
And maybe I'll just add, yeah, when we compare to provincial deposit insurance reserve funds, we're at the low end of that. So all of Western Canada and Quebec, they are higher than 100 basis points. So that's something we do look at. And BC is 134, Brad. So you were very close. You memorized it well. 134 basis points.
Great. Question here, which I think I've seen more than once as well, which is, was any consideration given to reaching the 100% or 100, it says percent, but I think it means basis point target before changing the target? I guess, 2 points there. First one, as Brad mentioned, we're now very close to the 100 basis point target, thanks to, in part, to the new accounting methodology. So we absolutely believe that it's time to start the conversation from that perspective. The other thing that I'd add is that while we have put off this decision to change the target for a couple of years now, notwithstanding analysis that showed that it was insufficient, as our data has gotten better and more tailored to the Ontario sector specifically, the inadequacy of the 100 basis point target has only been reinforced. And I'm personally of the belief that if you realize that the current target is wrong, you should start striving for the new target immediately. Obviously, we have waited until we were sure that 100 was insufficient, but now is the time, given both the increasing sophistication of our analysis and the fact that we are now very close to 100 basis point target. Vic, Brad, I don't know if you have anything to add to that.
Exactly. Yeah, exactly. It's the fact that we're now at the cusp where we're getting much better data, and the quantity. We've had 4 years of data, and it's been getting better every year. It's at the point now by reducing the amount of industry proxies and expert judgment. It is indicative of the experience in Ontario, and therefore we felt comfortable this was the right time to propose a change.
Good. Question for the group. I'm happy to pitch in on this one as well, but in the models for the DIRF, if $1 billion credit union fails in such a way that the fund must be used, what is the estimated expected loss to the fund? Meaning it should not be $1 billion, as there are presumably assets that can be sold.
Yeah, so it's going to be on a case-by-case basis. We'd have to take into account the level of liquid assets. There's going to be some timing issues there as well. So I mean, it's the situation where you need to, if it's a situation where it's a failure situation where you need to repay all depositors within a 7 to 21 day period, that's the expected payment, repayment, or the return of your deposits. That's sort of the international standard now. You're going to have to access funds a lot faster than you're going to be able to sell those assets, and so And that's where the difference between the immediate assets and then the long-term amount. The immediate is, well, how much money do you need today? Then you work out those assets over a year to 2 years. The expectation is that the short-term amount currently is contemplating some assistance from the Ontario Financing Authority line of credit. But as I said earlier, the expectation is that's paid back very quickly. And so we'd have to be in a position where you are liquidating those assets in a timely manner, and therefore at the end of that liquidation, what is the actual loss? What was the discount that you had to pay or take on those assets as you're selling them? And that shortfall would be the amount that would have to be covered by the DERF in a very short period of time, because you could not depend on the line of credit for a very long period of time. And that's where this analysis is coming in. So you have a lot of money early, but you have to make sure that you repay those funds that are coming from the non-DERF source in a timely manner.
Yeah, and I would add that this is why we look at financial stability structures, which include the DERF on a holistic basis, in line with, and Victoria mentioned this at the outset, our statutory object to minimize loss to the DERF. So not just the OFA line of credit, but the DERF itself can be used to extend liquidity support if there's evidence that in the long term, it will be repaid or be less costly than a failure, a disorderly failure of that credit union. At the same time, each of your credit unions is going through the process of formulating recovery plans that are deemed to be credible. That's very much a supporting mechanism that allows us to get some comfort around the type of support that may be needed when there is a crisis. And the $1 billion threshold that was chosen by the person who answered this question is an interesting one, because credit unions over $1 billion are subject to the requirement to submit resolution plans as well. And all of the resolution plans, which we're working collaboratively with credit unions on, are aimed at making sure that in the case where liquidation does ultimately manifest, that we take as much time as possible maintaining member-facing operations and reducing reputational risk to the sector, to allow time to either find a merger partner or engage in asset sales in a way that will minimize the delta between assets and liabilities and reduce the impact to the DERF. So there's very much a big picture element here. Emergency lending assistance factors in as well, which ultimately we hope to facilitate access for the larger credit unions. But ultimately, everything that we do in this space comes back to reducing the impact to the DERF and ultimately ensuring that we're satisfying our statutory objects in that regard. Victoria, question for you. Will sector feedback be shared with the Ministry of Finance?
Yes, and I think we do have some MOF representatives on this call actually taking notes and listening in, because as we mentioned before, the DERF target and the premium calculation and in the regulation are closely linked, and so they do want to be, MOF wants to be aware of the types of questions that we hear in this webinar. And you know, it's something that they will consider in reviewing any changes to the premium rates that are required. So I should also say, if you have any feedback on kind of the timeline to reach the DERF target or any considerations relating to premium changes, we welcome that in your feedback too, because we can pass that along to the Ministry of Finance.
Great. We've been hitting up Brad a lot, so I'll give him a bit of a break and throw you another one here, Victoria. At what intervals is the OFA commitment renewed? Will access to this line be available over the long term?
Sure. So the OFA line of credit, the Ontario Financing Authority line of credit, it's a 2-year agreement that gets renewed. The current agreement's a 2-year agreement with the possibility to renew at certain intervals. I would say it is a decision by the Minister of Finance to review it every time. So it's not under FSRA's purview, or I cannot really promise at this point that it's going to be renewed. So it is a decision that is reviewed every couple of years as it comes up for renewal.
Great, thank you, Victoria. And this is one that maybe I can start with and then turn over to you as well, Vic. But question here about what are some of the transition timelines that FSRA would be open to from the sector? Certainly, open to the sector's views on this. Again, what we're talking about here is a target, right? And so the implementation is less of an issue. Ultimately, all we're doing is setting a new point that we're trying to reach. I think this is probably much more of a discussion for the next round of consultation as we support the ministry on paths to get to the target. But Victoria, I'll turn it over to you to see if I'm wrong about that.
No, that's absolutely right. I think in terms of transition, I believe it's more applicable for any changes to premium rates, which again is, if the Ministry of Finance was to consider transition, there would be some transitional provisions in the regulation, and it's something that they would have to consider. I would also say that any changes to premium rates in the regulation would require a consultation on the Ontario Regulatory Registry for a 45-day period at a minimum. And so there would be, for any changes to premium rates, there would be another opportunity to provide feedback specifically on premium rates or any changes to the regulation. And the Ministry of Finance does have to consult on that. So yeah.
Good. I'm seeing a couple of questions here about, and understandably so, about PACE Credit Union and the impact on this particular discussion. We look forward to a point sometime in the future where we can talk a lot about PACE with the sector, but given the current state of affairs, both in liquidation and in some other venues, we're really not in a position to make any definitive statements at this point. Again, the second we are able to, we will be engaging the sector on the topic. We're just not in a position to do that right now. That's an unsatisfying answer, I acknowledge, but the only one that we have at this point. All right, just looking through, we have amalgamated a number of questions here. I still see that there are quite a few of them, which is great. Question here about why make changes prior to identifying credit union access to ELA and STLF? Fair question, I suppose, but again, we need to look at these things holistically. And ultimately, both ELA and STLF have a different purpose than the DERF. ELA is not available in a liquidation scenario, which is specifically what the DERF is designed to cover. Same for STLF. But these are meant for long-term viable institutions who in need of short-term liquidity support. The scenarios that we're looking at and the potential failures that result would not, those credit unions would not be given access to ELA, given the nature of those potential failures. So it's a conversation that we continue to engage in with Payments Canada, with the Bank of Canada, with our peer regulators to ensure that ELA and STLF are made available to credit unions that can take advantage of them. But it does not ultimately impact this particular discussion about the DERF, given, again, the different intent of those liquidity facilities relative to the Deposit Insurance Reserve Fund. Question here, which I imagine is on some people's mind. Is there any concern with changes to premiums impacting the decision of some larger credit unions to move to a federal model, and what impact that may have on the DERF?
Well, that would be a business decision for each credit union to determine how they would like to proceed. Moving to the federal regime is not a free proposition, nor is it a quick proposition for the 3 or 4 institutions who have gone federal. I mean, you can reach out to those institutions and you can learn from their experience as the regulator. I'm not going to make a statement one way or the other, but every credit union has to make the choice at the end of the day for the benefit of their members. And so that's as far as, you know, we have our objects that we have to be aligned with, and it's to ensure the stability of the sector and the long-term sustainability. And so if that requires a larger DERF to ensure that we can properly support the sector if there is an emergency, and therefore keep public confidence higher, that is the steps that we're going to take to ensure that, as our object states, we are to assist in the or to support the stability and keep comfort and keep public confidence high. It's said slightly differently, but that's the crux of it, right? That's number 3 on our objects. And so actions that credit unions take, whether they want to get into a new line of business or they would like to look at the federal, that's well within their purview. As we've said in previous discussions, please engage FSRA in that process so that we can ensure that you have the information that you need, so you're fully informed whatever action you would like to take, whether that's a new line of business or contemplate a move to the federal regime.
Yeah, so I mean, as Brad has articulated, it's absolutely part of the consideration, and obviously a large credit union moving to the federal regime would result in a short-term boon for the DERF, as the balance stayed the same, but insured deposits decreased significantly, but would ultimately make it more difficult for the remaining credit unions to replenish the DERF in the case that there was a large draw on it. So we factor all of these things into our analysis, into our discussions with the ministry. And so I think, you know, understanding that this is a consideration for some larger credit unions, notwithstanding the associated challenges, we are very much keeping it in mind. On sector access to ELA, is there a sense of timeline and required steps? I can start with this one. There is a sense as to required steps. I think the preconditions are public. If you go on the Bank of Canada's website, and I think we are working to move or to get across those hurdles as quickly as possible. Obviously, access to Payments Canada membership was one of the key hurdles, which we are expecting to be addressed quite soon. It then becomes a question of ongoing discussions with the Bank of Canada, with Payments Canada on the specifics, and making sure that the other things that are within our control, like, for example, a credible recovery and resolution regime, are in place, so that once access is there, we're in a position to take advantage of it. Brad, Victoria, I don't know if you have any additional thoughts there.
No, that captures it. I mean, yeah, there are things that, you know, agreements and such that have to be in place, and ongoing discussions with the Bank of Canada, but not having a firm timeline as to when all of the pieces would come together at this point. But yes, there are ongoing discussions and we are moving closer.
Yeah, maybe I'll just add one of the preconditions for having access to ELA is getting a provincial indemnity, which would require an agreement with the Minister of Finance as well. So that's another variable and step in the timeline that needs to be considered. And we continue to work with the Ministry of Finance as well, as long as with other partners, as well as with other partners, to move it forward.
Great. I've seen a couple of questions here about if we keep premium rates at the current level, how long to reach 120 basis points. I think this will very much be part of our work to support the ministry in consultations on potential changes to the reg. It's work that we're undertaking, but given the number of assumptions of moving pieces, I think we want to make sure that we have that conversation in support of the ministry's broader goals rather than in the context of the target. So appreciate that the question is of interest to the audience, and we will be addressing that as soon as we can. Question here, Brad. What have been total system losses over the last 25 years? Still struggling with so much of our members' money sitting in the DERF.
Yeah, so I mean, it's, if I had the graph, I would show it to you, but I mean, we had some huge losses near the end of the 1900s, going into the early 2000s, and then there were a couple of fairly large, spectacular failures in 2009 and 11, Portuguese and Croatian credit unions, and those put a huge dent into the DERF, and that's what sort of slowed the growth. But since 2011 or 12, and then the small amount that was used for PACE, there have not been any sizable losses. Now, like they say for mutual funds, past experience is not indicative of future performance. So just because it's been great for a decade doesn't mean that we can, rest on our laurels and then I think everything is fantastic, especially given the interest rates where they are, economic conditions where they are, and personal indebtedness and things like that. So yeah, I can appreciate that. Yes, these funds are being used, but they are there for it's like any insurance policy, right? You pay this money hoping you never have to use it, but you put the money there so that if there is an emergency, those funds are readily available. And so we are very cognizant of the fact that, every dollar that's paid into the DERF is a dollar that's not on a credit union's balance sheet, but at the same time, if and when we needed the funds and they were not available in the DERF and we had to go out and do a special levy to the sector, that would put undue pressure on the entire sector at a point when they're probably already in a bad position. And so that's the whole impetus behind an ex-ante funding process, is that you have the funds available so that you're not putting additional undue pressure on the sector when economic conditions or whatever the case may be are fraught at that point in time.
Great, thank you, Brad. I just want to emphasize for the purposes of the written feedback that we hope you all ultimately submit, because I'm still seeing a couple of questions about different levels of deposit coverage in provinces and how that should be factored in. I do want to stress that that's inherently factored into the calculation because we look at a proportion of insured deposits, not total deposits. And so whether coverage is unlimited or 100,000 or 250,000, that is, it's captured in that calculation because we are only looking at insured deposits, not total deposits. I want to stress that again, just to make sure that the written feedback is productive in that regard. We have about 4 minutes left. Question here, and Brad, maybe you can start, and I'd be happy to sort of join in. But what happens to premiums once the DERF target is reached? It actually says DERF limit, but I changed it because there's no limit on the DERF.
No, so I mean, as we will continue to be doing assessments on an annual basis. And so as you saw from that range, so other provinces provide a range. And so we have not yet contemplated whether we are going to introduce a range. We are just looking at a number. And so that should not be looked at as a mission accomplished situation. If you look at other provinces where they've set either a 15, a 20, or a 30 basis point range in which they would like to operate from the analysis that they've done. They believe that's the proper range in that situation. So if you look at what we've done, or the presentation here of 120 and 150, I'm not suggesting that that's going to be the range that we put in. We're just looking at what is the next target that we're aiming at. And as you can see from the analysis, that's the lower end of the stressed analysis. And so We will continue to assess the conditions. We'll be putting stress testing analyses together every year, looking at scenarios that are indicative of where the situations are now, looking at a 3- and 5-year horizon, and continue to assess that. And so as the need comes up, if a decision is made, we're not going to, I don't want to change, I don't think anybody wants to change the target on an annual basis, but as we get closer to the 120 basis points, as if the analysis shows that yes, 120 is still the right amount in 5 or 6 or 8 or 10 years from now, that we will remain at that level. The analysis that's completed over the next decade or 5 to 10 years leads us to require changes to that target, then we will make changes. Or if a decision is made to put a range in place, then we would look at that as well. But right now, the analysis is showing that at least 120 would be the appropriate number, and therefore, as I said earlier, we've all said today, we have to temper growing the DERF to a target or to the appropriate range, as the case may be, if we get to that nomenclature at some point, is to temper that with the fact that, how does that affect profitability and the long-term sustainability of the sector? And so, we're trying to juggle those balls at the same time, understanding that you don't want to grow the DERF too quickly to the point where you put in undue stress and then maybe need the DERF sooner than you thought you might need it because you put extra stress on the sector. So trust me and trust us that we are trying to find a happy medium to ensure that the DERF is properly sized and we're growing towards that in a meaningful and a timely manner to withstand the adverse but not extreme or severe stress scenarios at this point, and continue to grow towards that. So this will be an ongoing discussion with the sector. As we said earlier, we file a report with the minister on an annual basis where we make recommendations taking into account not only the DERF, but the other part of that report talks about the profile of the sector and issues that we're seeing that also feed into potentially making changes to the DERF target or a range if we ever get to that nomenclature at some point.
Good. We're very near time, so I want to quickly acknowledge that I have seen a number of questions about the specific stress testing methodology used that I avoided lest you see the abject confusion on my face as other people explained it. Ultimately, we wanted to sort of focus on the higher level elements as part of this discussion. The specifics of the scenarios were discussed in more detail with the DERF TAC back in October. I think as part of your feedback, written feedback, if you would like to understand more, we can certainly look at what else we can provide in that regard. A number of questions too, asking for more details specifically on what DERF growth has looked like. And I think we'll very much be able to share that information as part of consultation on any changes to the reg. But it is now top of the hour. I want to thank you all very much for your questions, for your engagement on the subject. Again, not surprising that it's of interest, but it's still gratifying to see the level of engagement. We have the email addresses up here for poor Brad and Victoria, who are going to be taking all of your written feedback. Notwithstanding your contributions today, very much encourage you to amalgamate the feedback from your credit union and provide a submission in that regard. It will be part of our discussions with the ministry as we ultimately come to a decision on this. With that said, it is 12:01. Thank you again. Have a good rest of the day.